Hey, Billy, how are you?
I'm good, thanks, and thanks for having me on.
Absolutely. Thanks for joining us. So this is one of our first interviews that we've done for the school.com community, the Ultimate Real Estate Virtual Meetup group. Um, a lot of investors on this in this community who are either just starting out or very seasoned or somewhere in between. And we are covering all kinds of real estate topics, educational. We do some fun things. We communicate via our forum for people to ask questions, and really, this is an opportunity for us to learn from the experts like yourself. So, welcome, Billy. Thank you for joining us today. So today we're going to talk about your business, you, and the great subject, exciting subject of taxes, which is so important in the real estate investing arena. And you're the perfect person to help us figure all that out. And but let's start with you telling us a little bit about you and your business and what you provide to investors.
Sure. So I am a co-owner of Summit Advanced Tax Strategy. The reason why I started this business is because, over the years I've cultivated somewhat of an expertise in, the real estate accounting and taxation arena. And I wanted to, form a company that was really centered around the client in terms of helping the client soup to nuts. In roles I was at previously, I was a little bit more of a cog in the wheel and only helping, maybe on certain aspects of the clients. But I wanted to start a firm where I can be really hands-on with my clients. And over the last year and a half that I've been out on my own doing this, we've been able to do that because we offer, accounting and bookkeeping services. We offer tax planning services. In terms of, our goal there is to make April 15th a formality, make it where, we know your tax liability if you have one ahead of time. And then after the tax planning is completed, then we do the tax returns as well. So it's allowed me to, like I said, be a lot more hands-on with my clients, and that's what I really enjoy. Um, the other thing that I really enjoy is saving people money on their taxes. It's my I feel like it's a moral obligation for everyone to pay as little in tax as possible. And as you said, real estate's a great way to make sure that that happens year in and year out. So the other thing I get, that I enjoy besides helping people in general is helping people save on their taxes specifically.
That's great. That's great. Well, great. Yeah, happy to have you here. And so, when it comes to tax strategy, I mean, your Summit Advanced Tax Strategy, it's in your name. How do you break down or frame what a strategy looks like when it comes to real estate and your taxes? Why,
Yeah,
why,
I think,
why should we care about that?
yeah.
And why should we consult with somebody like yourself who has that expertise?
Yeah. So, when you go to your accountant on April 1st, not only are they probably too busy to deal with you because they got a deadline coming up, but it's always by that time too late to implement a lot of, um, I hate to use a definition in the definition, but uh, it's hard for them to change your facts after the year is done. Of course, if you want to change your tax, you have to change your facts, right? So that's where tax planning and tax strategy comes in. If we can get ahead of the tax deadline and get tax planning and strategy in before December 31st of the tax year, then, as I was saying before, April 15th just becomes a formality. You already know what your tax liability is going to be, and everything's kind of baked into the cake at that point on April 1st. So, what we try and do with tax planning and tax strategy is say, okay, what are your goals, right? I want to buy 10 multifamily homes this year, or I want to sell this single family and get into multifamily, something like that. All of those different goals come with kind of curated tax strategies that we can implement to make sure that you're paying as being as tax efficient as possible. And so, somebody who comes to their accountant on April 1st, going back to the original example, if they said, oh, I sold this property, I don't want to pay any tax. Well, it's like, well, you could have done a 1031 exchange. You should have bought another property before December 31st, things like that. Whereas now it's too late and we have to, report a taxable event on your tax return. There's nothing we can do about it. and that's not always true, but that's by and large the truth. So again, to answer your question, implementing tax strategies is saying, how can we make sure that your business is running as tax efficiently as possible, and that way we know when April 15th comes around, you just either you're either expecting a refund or you just cut a check, and it's all kind of been planned out ahead of time so that there's no surprises.
That's great. That's great. And I agree. That strategy is really important. I think a lot of people, including myself, don't think about taxes necessarily until January 1st, and you have this looming deadline of April 15th, and you're like, okay, now I got to get all my ducks in a row. But really, that planning should have started in the previous year. Or if you're a new investor, setting yourself up for success in the coming years is probably something that you suggest. Is that right?
Yeah, absolutely. So, we help, depending on what your goals are. Again, we start with your goals. We help the new investor by making sure the entity structuring is correct and appropriate, educating on, the different types of levers you can pull early on to set yourself up for success in the future. And then we also help the seasoned investor, whether they have complex problems that they're trying to sort out, or if they're in, heavy expansion and growth mode with a lot of different moving parts. Tax planning, like you said, is for everybody. It's you either get set up at the beginning to grow in the right way, or, if you feel like you've just been going along and doing okay, but you want to get optimized, we can help with that too.
Yep, I agree. Now, I would imagine that a big piece of this puzzle is a person's own situation, right? So they could be in a W-2, and that might affect how their tax plan looks like when you start putting in real estate investments. Or if someone is a full-time real estate professional, that factors into a certain strategy. Can you speak to how you look at someone's financial profile, job profile, career profile, and then also the tax, or excuse me, the real estate investment piece, and how you marry those two, or approach a strategy around that?
Yeah, I mean, I feel like, first of all, the real estate investor community, as large as it is largely a DIY community. So right. I can't tell you how many times I've heard, I got my arms around this, I know a little bit, I don't think I'm ready for tax planning, things like that. The reality is even with a W-2 type person who's just starting out in real estate investing, people sometimes fail to understand or miss that, like, okay, what are some tax strategies that we can implement? Well, immediately you should be, maxing out your retirement account contributions. Does that help you get into real estate investing? No, but that's what we call the low-hanging fruit. Okay, so let's tick that box. Low-hanging fruit meaning that's the best way to shield W-2 income. Then we talk about starting, with real estate investing. If I have $50,000 and I want to, invest it somewhere, I can put it in a brokerage account. It'll earn, dividend interest income, which is, essentially impossible to shield from taxes, and then I'll get hit with taxes on that. Or I can turn around and invest in real estate, right? If it's a long-term rental, multifamily property, something like that, there's not a lot of tax benefits I can get usually because it's passive in nature, but all those distributions coming back to me from the real estate investment are usually tax-free, at least in the first couple of years. And that's something that people, sometimes fail to understand, is there's still a lot of tax benefits investing in real estate, even if you don't do it full-time like a real estate professional. And even then, somebody with a W-2, but maybe they have a spouse that wants to get into real estate, and their spouse can qualify as a real estate professional. So we break that down as well. And then kind of lastly, to your question, somebody who's in real estate full-time, 750 hours a year, we make sure that they have those passive real estate investments working in their favor as real estate professionals to help offset their taxable income from other streams. And on the W-2 side of things as well, we also explore the short-term rental loophole, which is basically a way to shortcut the real estate professional rules using short-term rentals to offset your taxable income. So I would say, like I said, it really affects everybody who's interested in real estate. And we just, again, game plan kind of what's the best situation for you to be in based on your goals.
I like how you said that the real estate investing community tends to be a very DIY community, either through the necessity or by control, control, the need to want to control things. I think that I hear that a lot, and so I'm gonna get vulnerable here. I have for several years now looked for a bookkeeper to handle my own real estate work as well as some of my properties, but it's hard for me to release the control of that, and I am completely DIY on that. Can you sell me on the reason maybe why I should use a bookkeeper now that I have a portfolio of about 6 properties?
Sure.
What are the advantages of maybe not doing things around this in this arena DIY? What am I
That's
risking?
it. And I would say that that is still a personal question, right?
Okay.
Because I was just talking to a property manager the other day, and it's like, if you have a really good property manager who has, really good care and reports on your books, honestly, at the end of the day, just a couple of multifamily properties probably isn't that much of a headache, and you're probably not ready to give up in terms of the overall LLC level bookkeeping. That said, if it's taking valuable time away from your business, whether that's looking for deals, expanding your money network, or taking away from your other real estate activities, such as I know you're a realtor, things like that. If you could be making more money doing the bookkeeping is not necessarily something you should be doing. You can outsource that and just review financials. Ideally you're working with somebody who you can trust from the outset, somebody like us, where we have our arms around the financials, rather than you going through 6 different outsourced bookkeepers before you find the right one.
Sure.
But that said, even if you could find a really good recommendation right away, you just got to look at how much time they're saving you and how much time you could spend, expanding your portfolio or expanding your network, and decide which one you'd rather be doing.
Definitely. I think it's that whole entrepreneur's dilemma of should I be doing $25, $50 an hour work if I can spend my time doing $250 an hour work, right? It's that tension. I think I've held back because some of my properties are held in LLCs, right? And some bookkeepers have charged per LLC. And in some situations, it just would hurt the cash flow if I'm assigning that as an expense to that LLC, which includes let's say one single family property. And so as much as it is on my time, it is also the profitability and the sustainability of that particular investment that I have to wrestle with as an investor. So I agree, it's a personal question, and every situation is different, but those are real things that in investing we have to face, and the decisions that we have to make. So
yeah, and that's again kind of where our tax planning comes in as well. If your system is the property manager takes care of most things and I do the rest at year end, we could go in and look at, okay, well, how did you do last year? How does the property manager reports look so far? Are we able to, get what we need out of that? And is it good enough? Or do we maybe start to, need to work on implementing, maybe looking at the books quarterly, something like that. I still think that you can have effective tax planning, even if you don't have a robust accounting system, because, you're at a point where your numbers well enough, and you don't need a complex system, or you are at the point of scale where it makes sense to have somebody taking care of things on a dedicated regular basis. So
yeah, that makes sense. How important is it for I'm all about in investing, it's a team effort, whether it's a contracted team member or a partner, or a capital partner, like team this is often not a solo sport, especially as you expand and scale. How important is it to have at least a tax strategist like yourself or a CPA who really understands the nuances of real estate taxes and those implications? How important is that, do you think, to have that that expertise on your team?
I love the football analogies. I've seen so many in my career that how life is a lot like football. So go with me on this,
Yeah, I
right? You
love
can
football.
have
Perfect.
Yeah, good. You can have a journeyman quarterback and have a pretty good season. But the tax strategist, the CPA is going to be your quarterback. And so if you have the confidence in your quarterback that they can coordinate the other parts of your team, you're going to have an okay time. Where we see people fall down is when they come to us and say, I just have a tax preparer. I don't have a tax strategist at all. We get in there, we found out the tax preparer is doing things wrong. They're not saving as much money as they could just in other areas, irrespective of whether or not they've done any tax planning or not. It just kind of is, if you don't have a good quarterback, the rest kind of falls apart. And so kind of as a result, you have to have that trust that they're doing a good enough job in your favor, quarterbacking your team, your attorneys, your financial planners, bookkeepers, property managers. That's one of our questions on our kickoff calls on our tax strategy engagements. It's who's on your team that we need to be aware of and handing the ball off to. And as long as we have an understanding of who all those people are, some of those people are me, some of those people are the client. We can wear multiple hats, but we got to make sure that all those bases are covered so that everything is moving smoothly in the right direction for your benefit and ultimately your tax optimization.
That's great. Because it's real money we're talking about, right? It's real money in your pocket that you're potentially losing out on or sacrificing because you just don't have the right people on the team with the right expertise. So thank you. Yeah, I agree with that. So I know that you attend a lot of meetups and conferences to get your business name out there, of course, and meet other investors and source business and all that stuff. But in your interactions with real estate investors, what do you feel like separates the savvy investors from I don't want to say less savvy, but the investors that probably can put some different pieces together to take them to the next level? Really focusing on what are you seeing in terms of like the savvy investors and what kind of makeup are either those people or how they run their businesses, their investing business?
So to me, the most successful are, kind of going back to the last question, the ones that are really in tune with their team. The best one, we have the most productive conversations when the bookkeeping is, at least somewhat caught up, right? And, we're not waiting on 2 prior years of tax returns to be completed because they weren't on top of that end of things. The way that we look at the financial picture is, let's start with the prior tax year, and then now we can start with the, current tax year. But what we run into is if we can't rely on the numbers in the bookkeeping, or if those prior tax returns aren't completed, we waste a lot of time during the tax year that we could be planning and getting ahead of things otherwise, while we wait for all that stuff to be cleaned up. So, other people will do okay without the accounting and the tax returns filed, but you can have the most productive conversations and the most impact when those are completed, and the people who put the value on that. And the reason is of course, accounting is the language of business, right? If you want to talk how to grow your business, what KPIs can we implement, what benchmarks can we hold ourselves to, those all come from the numbers and the data in your financial records. So, having an understanding and appreciation for those things really separates the productive conversations from it could be this, but we got to wait and see type conversations.
Yeah, I totally agree. It's almost like I just thought of the football analogy. It's almost like starting 10 yards behind the line of scrimmage before you can even start from the line of
Yep.
scrimmage. A loss of yards where we're just going to play a little catch up, and that's going to take time and effort, and then we can start looking forward rather than looking back.
Right. And so, again, on the first call that we have in our planning engagements is everything caught up? Let's sit down, start with where we are, and then start with your goals, and then what steps do we need to take to start the building, the planning, start the building blocks of planning, and get to where we need to go. So
great. So let's talk about the big D word, which is, where I'm going with that.
Depreciation. Yes.
Depreciation. One of the biggest benefits of real estate investing. For anybody out there who is new to real estate and has heard this word probably, but can you just give us a sense of what depreciation really means? And then I'm gonna climb the ladder from that and work our way up to more sophisticated topics on that. But define depreciation for us.
Yeah, I'm trying to think of how far back we should start. I think the best place is if you buy a pen for your business, your real estate investing business, you can immediately deduct or write off, a lot of people say, the purchase cost of that pen. But when you buy assets, you don't always get to write them off or deduct them when you purchase them. Some of them you have to depreciate. And what depreciation is a way to account for a useful life of an asset. So for example, the IRS says your car is going to last you 5 years, usually. And so therefore, when you buy a car, you don't deduct the purchase price in the first year necessarily. You put it in service as an asset and depreciate it over 5 years. Now, there's, of course, a bunch of special rules around how you can write it off in the first year. But first, you have to depreciate the asset by putting it in service as an asset. And so what depreciation is it basically it accounts for that useful life of the asset over time. And where it comes in handy in real estate is, first of all, we know in general, especially here in Colorado, real estate appreciates. It gets, it gains more value over time. But the IRS says when you are, renting that asset out to other people, the real estate asset out to people as a rental, you can account for the wear and tear of that property over time by taking a depreciation expense. So you buy a $100,000 house, you put a tenant in there, and you can expense that $100,000 over 27 and a half years while that asset is appreciating. So appreciation is an increase in value. Depreciation is the decrease in value from the wear and tear. I feel like that's a good place to stop.
Yeah, and so basically that value of that house is broken down, divided by 27 and a half, and that amount is considered a depreciation deduction, correct?
Exactly.
On your taxes.
Correct. So if you bought a $100,000 house in 2024, you would take an expense roughly 1/27th of that in 2024, 1/27th in 2025, 1/27th on and on.
Right. Great. And something I learned, I'm gonna take a little tangent here off of depreciation. Something I learned recently, and I consider myself a pretty savvy investor. But I was deciding whether to 1031. We can touch on 1031s maybe a little later, but I was deciding whether or not to 1031 a property. And I realized that when I was going to recapture that in the sale, I would have to recapture the depreciation that I've taken on that property. I thought I was going to have to pay back the total value of the recaptured, but it's actually taxed at a percentage of that depreciated value. That's right?
Kind. So bonus depreciation is, generally speaking, ordinary income. But the depreciation that you're talking about is capped at 25%. So if you're a high wage earner, you're not necessarily going to be hit with depreciation recapture at your 37% tax bracket because it's capped at 25%.
Got it. So just for people out there who are listening, when your accountant or Billy, when you're working with him, talks about if you don't 1031 this property, you're gonna have to recapture that depreciation that you took on however many years, but you're not gonna have to pay back 30,000, let's say 10,000 a year over the last 3 years. It's a percentage of that amount that the IRS is going to expect back in your next tax return, right? Essentially.
Yes. So yeah, if you were taking deductions at that higher tax bracket, the recaptures that could be potentially at a lower tax bracket. What we usually find is nobody really hits that 37% tax bracket in real estate investing.
Yeah.
They would have to be a situation where, they are very well paid in their W-2, and then maybe their spouse is a real estate professional. Obviously, it could happen in a lot of different avenues, but I'm just talking the majority of my clients. But you do get some benefit of the recapturing. You're not completely SOL.
Yeah. Great. So you just mentioned it. You just hinted at it. Let's take it to the next level. Over the last 2 years, there's been a lot of conversation about bonus depreciation.
Mm-hmm.
Talk to us about bonus depreciation. Define it, and how do we use it as real estate for our benefit?
Yeah. So when there's in the simplest terms, there's two types of property, right? Real property, which is buildings, building structures, and there's personal property, which is pretty much everything else. And so personal property, generally speaking, is depreciated in less than 20 years of a class life. And buildings are depreciated usually in 27.5 or 39 years class life, depending on their use. So on the personal property, because they are less than 20 years of a class life, you're able to claim bonus depreciation when you purchase those assets and put them in service. And what that means is that there's special calculations you can do to deduct more than the class life's worth in the first year. Bonus depreciation is a provision that says, yes, if this asset is in this class life, you can depreciate a large chunk of it, or sometimes the entire amount in the first year. And then the rest of whatever's left is depreciated over the class life. So let's go back to my car example. Although car is not a great example because there's a lot of special rules. But let's say you bought a truck for your real estate investing business, and that truck cost $20,000. In 2024, you can deduct $12,000, assuming that this truck is 100% business use, and that remaining $8,000, 20 minus 12 is 8, can be depreciated over 5 years. And the reason why it's been a sticking point as the last couple of years is because when the Trump Tax Cuts and Jobs Act went into regulation in 2018, you could write off everything in the first year, the 100% in the first year. Then last year it became 80% in the first year, and then this year it's 60% in the first year. Next year it's 40% in the first year, and then before the Trump Tax Cuts and Jobs Act, it was 50% the first year. So they've been playing with that to stimulate the economy, and who knows? I'm not an economist, but ultimately, people like when you can write everything off in the first year for an asset. So.
Yeah. Did I hear something fairly recently that there was legislation that brought back bonus depreciation to a certain level? Is that right?
Yes. So I believe legislation has passed the House. Of course, it's got to pass the Senate and be signed by the president. That brought back 100% bonus depreciation for 2023, I believe, through 2026. I don't think it's indefinitely.
Okay.
But ultimately, what that would mean is if the Senate were to pass it and the president were to sign it, we would then be able to potentially go back in time for anybody who's filed their 23 return and claim those deductions that you didn't claim. What I suspect will happen now that we're into July and it still hasn't passed the Senate, I think there's going to be some kind of administrative procedure that says, if you made these deductions in 2023, put this form on your 2024 return and you can catch back up, something like that. Because if the IRS has to deal with millions of amended returns, they're probably going to break. So,
right. And being an election year, 2024, all of those things went in under Trump. If Trump gets elected again, we might see that back on the table, right? Pretty swiftly. I don't know. It's
Yeah, I
quickly,
would
but
think that, Congress would want to claim the benefit for themselves. But yeah, like you said, since it hasn't happened by now and it is an election year, they're probably waiting for to see if the tide turns at all. So
yeah. All right, I'm going to connect to the next topic as we go up the ladder. Cost segregation studies.
Yep.
Correct me if I'm wrong, that is the primary mechanism that you use to claim bonus depreciation, correct?
It is on a purchased property, yes. So if
Okay.
I go out and buy this $100,000 house from our previous example, you have to account for land, which is non-depreciable, and you have to account for the building basis, which, as I said, is depreciated on a long-term rental over 27 and a half years. But if I go and get a cost segregation study by an engineer completed, the engineer will assess my building based on their know-how and experience and expertise on different assets and their value and things like that. And they'll assign the value of the components of the house to different class lives according to how the IRS lays them out. So what's an example of that? So, let's say on this $100,000 house, $20,000 is land and $80,000 is building value. The engineer will then go into that $80,000 portion and say, okay, $5,000 is the floors, $5,000 is the appliances, $10,000 is the roof. And from those examples, we would know and assign them a class life according to the IRS that says you depreciate flooring over 5 years, you depreciate appliances over 5 years, and you depreciate roofs over 27 and a half years in this example. And so the benefit of that is that, if I don't want to claim bonus depreciation, I don't have to. My 5-year property, I can just get more deductions the first 5 years and then let the rest be depreciated on the back end. Or what most people do is claim that bonus depreciation in year one. In this example, those two assets we would deduct $6,000 and then the rest over 5 years. And then, that roof stays constant 27 and a half years, no matter what. And so we're able to take those giant deductions in year one and do a lot of tax planning with them, right? If I just have the one property, I know that, in future years, I'm probably not going to pay a lot of tax, if any, because I have a large loss carrying forward every year. If I'm selling a building this year and I have a $10,000 gain, but I'm writing off $6,000 from this bonus depreciation on this property that I bought, my gain now becomes $4,000. So I'd save a lot of money just by buying a new property. So again, those are kind of the levers that we pull with a cost segregation study to say, how can we optimize your tax situation using bonus depreciation and depreciation in general effectively?
Got it. So let's play a little case study on my own situation.
I was going to say, do you know a guy?
I do know a guy. Yes. I have
Asking for a friend.
a few weeks ago we closed on a 20-unit apartment building. And we're going to take our strategy on this, our value add strategy is that we are going to convert from 20 long-term rental units to 20 furnished units. So we're going to do some rehab, some improvements. We're going to furnish all of them. So we're planning for about $3,000 to $5,000 per unit to furnish. And naturally, the conversation I want to have with the team is it going to be in our best interest to perform a cost segregation study on this? My question to you is, what are the things I should be thinking about, my team should be thinking about to pursue a study of this type? What are the things we should be thinking about or evaluating, go, no go on that?
Yeah, so, especially when it comes to multifamily properties, single family is a bit of a different conversation. The power of the cost segregation study doesn't stop at, componentizing the purchase, as we just discussed, right? When you buy a property, you do a cost segregation study, they'll tell you Again, 5,000 flooring, 5,000 appliances, etc. But when it comes to value add, it's important to know the purchase price of everything you're buying, because if it's currently in service as a rental and you go in and you turn those over, you can then know the value of what you bought so that you can then dispose of it and put the new assets in service. And the process of doing that is called partial asset disposition. So let's say this 20 unit apartment needs a new roof. And we know from our study that the roof is worth $10,000. You buy it on day one, the asset's in service. And then if you take that roof out of service and put a new roof on it for $20,000, you have to depreciate that roof over 27 and a half years, 39 years, depending on its use. But that old roof, you can take a $10,000 deduction for. So that's not a bonus depreciation thing. That's I'm doing value add to this property, and I can get deductions for what I'm throwing away. And that process is called partial asset disposition. So
we did that. We did that.
Good.
We actually closed, and then the next day, it has a 20 stall garage detached. And it needed a new roof, so we immediately put a new roof on the next day after closing.
There you go. So yeah, if we're not working together on this one, you ask your accountant, hey, what deductions are we getting for that roof disposal on day one?
Right.
And make sure that they're getting you those deductions. But then, so yeah, if you go in, you do all the tenant turns, you have to replace 50% of the appliances, and the appliances were worth $5,000. You can get a deduction for $2,500 for the ones you replaced, and then put the new ones in service, essentially allowing you to double dip on bonus depreciation, because those new appliances also qualify for bonus depreciation. You don't need a cost segregation study. Appliances, what class life those are. But when you're working with an engineer, what's great about that is they're able to componentize the components. So things that you might ordinarily have to depreciate over 27 and a half years, depending on what it is, they're able to go into those individual specific components. If it's, like a new structure you're putting on, and then break the structure down into 5-year, 7-year, 39-year class life. So working with an engineer in a project like this becomes super valuable, because they can just help you where every deduction possible out of it. And then, like we said, you go to your accountant, you don't have to claim bonus depreciation if you don't want to, but you're getting the most depreciation upfront as possible. Reinvest, the tax savings with time value of money, and you come out ahead. So
that's the key. My next question would be like, what's the real benefit of that? And you're exactly right. Money that we would pay on taxes, quantify that, and then reinvest that into something that actually makes us money, right?
Exactly.
Yeah.
Yep.
Yeah. Okay. Awesome. Well, thank you for that.
Of course.
And yes, I do. I know a couple people that do cost segregation studies, and those are good people to know. So the other thing about cost segregation studies I didn't realize is that you can go back. If you bought a property, let's say in 2022, you can go back to that property, do a study on that, and factor that in. Is that correct?
That's correct. And we do that all the time. And the benefit of that, in addition to just getting the deductions today, is that it goes back to what was the tax law in 2022. So if you buy the property in 23, you're subject to that 80% bonus depreciation limitation. But if you bought it in 22, you get to take advantage of 100% bonus depreciation for that, because that was the law of the land that year. So that's something that we sometimes do to say, that was kind of going back to our original conversation here. What can you do on April 1st? That's one thing you can do on April 1st, is say, I need a cost segregation study. You're not going to get that return filed by April 15th, but you can extend your return, go back in time with the depreciation out, put that on your 23 return, and then take advantage of that. But again, that's a very, limited use situation that we try and get the cost segregation studies done in the year of purchase, because we have to file a lot more paperwork, which makes your return a lot more expensive to go back in time like that.
Right.
That's
so
called
anybody listening, if they bought a property in 22 or 23, you might be able to go back and reevaluate your bonus depreciation
exactly
scenario on those. So
And when we're preparing tax returns, we always, assess and make sure that we're not leaving anything on the table before we file in terms of fixing depreciation like that. Sometimes you're just stuck with depreciation as it is, and it's not worth going back and fixing. For example, I had a client who just forgot to depreciate his long-term rental for 1 year. So he really only missed out on like $400 of deductions. And it's like, well, we're not going to fix that because it's going to cost you $1,000 at least to fix it. So let's just let sleeping dogs lie and move on.
Cool. The thing I think we have to remember, though, is if you decide to go sell that property and you took a lot of the depreciation up front, that's going to carry through. So that may actually affect your decision on should you do a 1031. So you can keep the deferred taxes going onto the next assets. Is that correct?
In its simplest terms, that's correct.
Yeah.
A lot of people, first question when it comes to cost segregation studies, first question is, do you plan on holding the property for 3 to 5 years? And if the answer is yes, then we're going to go ahead and do the cost segregation study because we found that the time value of money, you'd rather have those deductions today than 3 years from now, and we'll just kick the can that far down the road. The other thing to consider too is if you sell year 6, by the IRS's own definition, all that 5-year property is worthless. So the recapture doesn't hit you as bad. So, that's a consideration as well. But in general, 1031 exchange is where if you sell a property, you can buy another property and essentially swap them. You usually need to use a qualified intermediary. That's a person who facilitates a 1031 exchange. But what happens is the basis of the old property steps into the shoes of the new property. So, going back to our $100,000 house, if you buy a $100,000 house, rip out $10,000 depreciation, then you sell it and go buy a $500,000 house, you only get to account for any cash or new debt you brought to the deal. Otherwise, your basis in that $500,000 house is $90,000. And you can't do a cost segregation study on that because it's already been in service. So it's a lot of considerations there, but in its essence, 1031 allows you to avoid any of that depreciation recapture and just buy a new property with the proceeds from selling and not recognize any gain.
Exactly. We could do a whole show on 1031. That's a large topic, and I hope we can do some of that in the future around 1031. But that's a powerful tool, right? I think. I personally have done a 1031. I've helped clients do 1031 exchanges. It really is a powerful tool when it comes to taxes. Is there anything else you want to say about 1031 exchanges?
Well, if we're looking at 100% bonus depreciation again, or even with 60% bonus depreciation on the right deal, we sometimes skirt the 1031 by doing what we call the lazy man's 1031, which is buy a new property, do a cost segregation study, use the losses on the new property to offset the gain from the old. A lot of people don't like the 1031 exchange because it has a lot of stringent rules and timelines. So in the right market, in the right environment, and with the right property, you can just use a cost segregation study in lieu of a 1031. You sell the property, recognize the gain on the old property, then buy a new property and rip out the depreciation on the new property. So it's definitely 1031 is one of our favorite tools, but there's also ways around that as well.
That's exactly why you should work with somebody like Billy because they're gonna. I didn't even think about that as a possibility, as an alternative to how to look at 1031 or your specific someone's specific situation on a given investment. So interesting. So I
had a client do a 1031 to defer a gain of about $3,000.
Right.
And once it was all factored in, they would have been better off not doing the 1031 because their tax savings was about $300 and their 1031 fees were about $1,000. So
right. Exactly. I'm in the process of that now, evaluating if I should do a 1031 on a property or just pay the tax. But again, that has to do with your profile. Me as a real estate professional, that has different implications. And I have multiple properties on the books. And so that entire profile is important when evaluating whether to to implement some of these strategies.
Yeah, and when it was 100% bonus depreciation, that made my job a lot easier. When you only own a portion of a property, a large multifamily, something like that, that makes the calculations harder as well. So that's going back to why we do proactive planning. Getting with somebody that really understands your situation and your goals. It's not always so cut and dry, even though, again, real estate investors are a DIY bunch in general. So
yes. Well, good. Well, I think this has been a great time together. I hope everyone listening has been able to learn something today. Hopefully more than you expected around depreciation and bonus depreciation and segregation studies, why you should do tax strategy and planning with someone like Billy, or your CPA who understands real estate, and the importance of team and having the right expertise on your team. So thank you, Billy. Where can we find out more about you, your company? What would you say to that?
yeah, so you can follow me on LinkedIn or Instagram at Billy Withers Tax. You can always email me at hello@summitats.com, or you can check out our website and see if you're a good fit to become a client at www.summitats.com.
Awesome. Well, thank you for joining us today, Billy. We learned a lot, and hopefully some people get in touch with you, and we'll see you around. We'll see you around town.
Absolutely. It's a pleasure. Thank you.
Thanks, Billy.